Hello friends, we all know that bank deposits are insured up to rupees 5 lakhs by the DICGC, that is Deposit Insurance and Credit Guarantee Corporation, a wholly owned entity of RBI. The amount of sum assured by the DICGC has been steadily increased from 1500 rupees in way back in 1962 to 5 lakhs now, and the premium charged on the deposit insurance has been so far at a flat rate. Currently, it is 12 paise per 100 rupees of bank deposits that are insured by DICGC. But now, Reserve Bank of India has introduced risk-based premium framework effective from 1st of April 2026. Hence, the banks will be required to pay the premium at the rate that is specified after assessing the risk management system followed by the banks. That is, those banks which have a robust risk management system and are graded as low-risk entities, they will have to pay lesser premium, and those which are not able to manage that kind of risk management architecture in the bank will have to pay full premium, that is 12 paise. So for this purpose, the banks will be categorized into 4 categories, that is A, B, C and D. That is the 4 categories of banks that are now classified, and the premium will be aligned to the perceived riskiness by the Reserve Bank of India. Now, henceforth, a differentiated premium will be paid by the banks. For example, all the banks will be categorized into A, B, C and D. That is the 4 categories. The A category bank will pay 8 paise, that is the lowest, against 12 paise. That means it is going to pay 4 paise less than the premium rate, that is 12 paise. 8 paise, A category, B 10 paise, C 11 paise, and D will have to pay 12 paise. That is the standard premium. That is the upper edge of the premium. So, the premium that will be paid by the banks will be differentiated on the basis of robustness of risk management system that they will be following. This risk-based premium framework is in line with the international best practices, because we are insuring up to 5 lakhs, but different economies have different kinds of limits for insuring their own bank deposits. Because in about 110 countries, deposit insurance system is in practice. Means most of the bank deposits are insured by the regulated entities. So in US, FDIC will be, that is Federal Deposit Insurance Corporation. It will be insuring the deposits up to $250,000. Whereas China, renminbi 500,000, Japan 10 million, Germany, Euro 100,000, UK, GBP 120,000. Whereas in India, it is about 5 lakhs. So, these 5 lakhs deposits will be insured for every customer held in every bank. So, 5 lakhs of rupees up to 5 lakhs, savings bank, current account, term deposits, all kinds of deposits, including interest accrued, will be covered by the DICGC. And the change that has now been brought is the risk-based premium framework that will be brought into force soon. Now, another good thing that has been introduced by Reserve Bank of India is the vintage rebate, which is very unique, which is not there in many of the countries. That is, the concept is many of the banks have been contributing to the creation of deposit insurance fund of DICGC. That is, they are paying consistently the premium on the deposit insurance, but there is no claim or distress or any risk event where the claims have happened. So if those kind of entities will also have to be compensated, that is the thought process, as a result of which the RBI has introduced what is known as vintage rebate. That is, vintage benefit will be given to the regulated entities at the rate of 1% of premium for a maximum of 25 years. That is, maximum the banks can get 25% rebate on the deposit insurance that they need to pay. That is the insurance premium. So, take the example of an A grade bank, which is rated as the A grade as far as the risk management systems are concerned, and that bank is paying 8 paise. In addition to 8 paise, they will get another rebate of up to 25% on the 12 paise, that is the rebate because of the vintage benefit. That is, if the entity is in existence for more than 25 years, then they will get full rebate. But the only condition is there should not have been any occasion of distress or restructuring of the bank which has attracted any kind of claims by the customers of that entity. So, most of the banks which are in existence for more than 25 years will be getting the full benefit of vintage discount. So, two types of discounts the regulated entities will get. One is the risk-based premium, that is for a reward for best risk management systems, and another one is for contributing to the deposit insurance fund of DICGC, because about 2.29 trillion of Indian rupees is the corpus of deposit insurance fund, which is with the DICGC for the purpose of making any settlement if there is a claim by any of the depositors of any bank, like what has happened in the case of PMC Bank, what has happened in the case of the banks, the New India Cooperative Bank, or any bank which has put under the moratorium by the bank, by Reserve Bank of India, moratorium by Reserve Bank of India. In that case, the claims were made by the depositors. In that case, that entity will not be entitled for the vintage. Their vintage period will start after the restructuring or after the distress event has happened. So, they will not be getting that benefit, vintage benefit. So, there are two kinds of changes that have happened, and it is very good because it is going to encourage the banks to implement the best of the risk management practices so that they will have to pay lesser premium to DICGC for getting the same level of insurance from the DICGC. So, it is a good thing. As far as vintage benefit is there, vintage benefit is almost uniform for many of the banks which are already in existence for over 25 years. Vintage practice has not been there in any country because I did not find any country giving any vintage benefit to the regulated entities. But risk-based premium is charged in most of the countries. That is an international best practice. And International Association of Deposit Insurance that brings out best practices. The International Association of Deposit Insurers, this has been formed on May 6th, 2002, which is giving guidance to the deposit insurers, and it has issued core principles way back in September 2009, which were revised in 2014. According to that, there is the risk-based premium is to be charged. So, if you sum up the developments that has taken place, henceforth the load of payment of deposit insurance premium will be less on those banks which manage the risks better, where the reading of risk, the perception of risk observed by the regulator under RBS, that is risk-based supervision, is low. That is, if they come under the A category, they will have to pay only 8 paise premium. So, that is the biggest advantage that they are going to get. And as the deposit amount increases, now 5 lakhs is the deposit insurance. And now let us see if there is any upward revision, because last revision was made in 2020 that was raised from 1 lakh rupees of deposit insurance to 5 lakh rupees. So that was the last change made. But this change is to the benefit of regulated entities. As far as the customer is concerned, there is no change, because anyway customer doesn't have to pay any premium for the deposit insurance. Only the bank which is holding the deposit will have to pay the premium. So it is a good development as far as the banks are concerned, because the burden of payment of premium will come down, and they will get both risk premium, risk discount, risk-based discount, and also vintage benefit. So we will talk more about the developments in the banking sector as we go forward. If you have not yet subscribed to this channel, please do subscribe. Share it with your friends. We will be talking more about the developments that are taking place to educate the banking community and the potential students who would like to be engaged with the BFSI sector. All the best to all of you. Thank you very much.